Coming up on Market to Market. Neither rain nor snow keeps the postman from his appointed rounds, but red ink will. The Agriculture Department releases its latest estimates on supply and demand. And a trip to the grocery store reveals the impact of persistent drought. Those stories and market analysis with Jamey Kohake. Next.
Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success. This is the Friday, February 8 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. The scales of global commerce tipped in favor of the United States late last year, driven by dramatic improvement in America's seemingly unquenchable thirst for foreign oil. According to the Commerce Department, America's cavernous trade deficit narrowed more than 20% in December to $38.6 billion, its best showing in nearly 3 years. U.S. exports rose more than 2% to $186 billion. The improvement was paced by strong foreign demand for American-made aircraft and agricultural goods. And in a development boding well for the future, U.S. exports of oil and other petroleum-based products rose to an all-time high. Imports shrank nearly 3% to $225 billion. Crude oil shipments into America plunged 223 billion barrels in December. That's the lowest level of oil imports in more than 15 years. A smaller trade deficit bodes well for the economy because it indicates U.S. consumers spent less on foreign products, while American companies earned more from sales overseas. But some businesses continue to struggle. And that was readily apparent this week when the Postal Service announced plans to end Saturday deliveries. Neither snow nor rain, nor heat, nor gloom of night stays these couriers from the swift completion of their appointed rounds. Except on Saturdays. In a cost-cutting measure that is expected to save $2 billion annually, the U.S. Postal Service will cut Saturday delivery of mail. Founded before the signing of the Declaration of Independence, the agency has been suffering over the past few years due to increasing costs and decreasing volume of first-class mail.
The plan saved $2 billion annually, but we have a $20 billion gap to close. We're striving to raise revenues, reduce costs, and gain efficiencies throughout the entire organization. And making this change to our delivery schedule is a big-ticket item, and it is simply too big of a cost savings to ignore. In fact, I would strongly argue that it would be irresponsible for the Postal Service not to pursue this course.
According to Postmaster General Donahoe, single-piece mail delivery has declined 20% since 2010, and the agency is losing $25 million per day. However, the Postal Service is experiencing a 14% increase in package delivery, and it will continue the service 6 days per week. The agency receives no tax dollars and is funded solely through the sale of postage stamps. Last year, the Postal Service lost $15.9 billion, including $11.1 billion in payments to retirees. Because of the shortfall, the agency had to default on the pension payments. Since 2006, the agency reduced its workforce by 193,000 through attrition and retirements. It also consolidated 200 mail processing facilities, eliminated 21,000 delivery routes, and reduced hours of operation in 9,000 post offices across the country. While proposed changes for the Postal Service require congressional approval, Donahoe believes the move is legal under the continuing budget resolution, which expires March 27th. Reaction from Capitol Hill has been low-key, with a few lawmakers supporting the move and one expressing concern over the potentially negative impact on his rural constituents. Donahoe is confident any differences can be worked out over the next month. And according to a recent poll cited by the Postmaster General, 70% of Americans have no problem with a one-day reduction in service. However, reaction from some rural Americans ranged from resignation to concern.
The American public wants to deliver they want to receive their mail 6 days a week. If they cannot get it from the United States Postal Service, other companies will venture out and do that. They will get it somewhere. People still believe, still trust that as long as their mail is coming, that the America that we live in today is safe and secure.
While others believe most deliveries can wait until Monday, some senior citizens are concerned that they could be left waiting for important mail, like Social Security checks.
We're going to have to get all of our information from the internet, so I don't know how that's going to work out, but I'll see.
Officials with the Center for Rural Affairs in Lyons, Nebraska, are also concerned about the impact on seniors and rural businesses. They are encouraged that package delivery will continue without interruption, but voiced some apprehension over whether this was an indication rural mail services might be further reduced in the future. The final day of Saturday letter service is slated for August 3rd. President Obama urged lawmakers this week to approve at least a 3-month delay to automatic spending cuts currently scheduled to take effect March 1st. In the meantime, farm subsidies are being eyed as a potential bargaining chip. According to Senate Agriculture Committee Chairwoman Debbie Stabenow, the prime targets for spending cuts are direct payments that compensate producers regardless of yield or market price. Stabenow says she would prefer that farm policy reforms be made in the broader context of the Farm Bill, but the Michigan Democrat told Politico this week she cannot defend direct payments. Tinkering with the 2013 payment levels could significantly impact the ability of farmers to get financing. And with the nation gripped in the worst drought in half a century, any changes in the farm safety net could have sweeping implications for producers and consumers. As snow falls across America, the reduction of drought is slight. This week's snow cover map from Intellicast shows increasing snowpack in the northern states, but it's nowhere near the amount needed, as evidenced by the University of Nebraska's Drought Monitor. Just under 68% of the land in the continental U.S. is rated abnormally dry to the exceptional drought category, down almost 2 points this week. The arid conditions prompted a USDA economist to say higher than normal food price inflation is in store for this year.
It had substantial and devastating impacts on the major field crops of the American Midwest. The most important field crop there is field corn. Now, people don't eat field corn directly, but it's processed into animal feed. That's a major input to the U.S. food supply chain. So we're seeing input costs rise for all the meat products and then all of these animal-based products that consumers buy regularly. We're looking at inflation on the order of about 3 to 4% for beef and veal, pork, poultry, eggs, and even a little bit higher for dairy. For dairy, we're looking at probably 3.5 to 4.5%.
Volpe says the second half of the year will likely be when the full effects of drought will be realized on the price of processed food.
These all rely on commodities. They rely on field corn and soybeans and so on, and those input costs are going up. It's just that due to the more stages that are involved in bringing to the supermarkets and the contracts that govern these commodity prices for those foods, consumers won't see that till later in the year, and even probably to some small extent in the early part of 2014.
The rise in commodities may not impact all items in your grocery store aisles, as normal food price inflation of 2.8% is likely to be in place for most items.
So for most food categories that are not impacted directly by these higher commodity prices, especially field corn, we're looking at pretty normal food price inflation.
Next, the Market-to-Market Report.
Residents of New England braced themselves this weekend for what is predicted to be a huge and possibly historic blizzard. The storm is forecast to dump 1 to 3 feet of snow from New York City to Boston and beyond. But even before a single snowflake fell on Friday, schools in many northeastern cities were canceled. Commercial airlines scratched more than 3,700 flights through Saturday, and the disruptions are expected to ripple across the nation. Meteorologists say wind gusts could reach 75 miles per hour. And residents are preparing for widespread power failures and flooding in coastal areas still recovering from Superstorm Sandy in October. Against that backdrop, the Agriculture Department did a little forecasting of its own Friday when it released the latest estimates on global and domestic supply and demand. With the 2012 row crops already in the bin, the report focused primarily on grain supplies. U.S. corn ending stocks moved slightly higher to 632 million bushels as export demand fell off. The increase over last month still leaves corn at one of the tightest stocks-to-use ratios in the past few years. The increased supplies pushed the season average price estimate lower by 20 cents to $6.75 to $7.65 per bushel. As we move closer to the start of the 2013 growing season, Private analysts note there is little room for a crop shortfall in the northern hemisphere. Domestic soybean ending stocks also remain tight, with USDA officials moving estimates down to 125 million bushels. Despite the reduction, some private analysts judge world stocks to be adequate as they anticipate a record South American crop. After weighing all the factors, USDA increased its season average price estimate by a nickel to $13.55 to $15.05 per bushel. And as supplies decline, U.S. wheat ending stocks were pulled slightly lower to 691 million bushels. As more wheat is being used as feed and exports continue on track, the market is having difficulty breaking the $8 barrier. However, USDA prognosticators disagree and moved the average season price estimate up 10 cents to $7.70 to $8.10 per bushel. Grain markets appear to have already anticipated the supply figures as wheat and corn rallied a few pennies on the news. Nearby soybean prices, however, declined about 15 cents in the wake of Friday's report. Grain prices posted modest gains in the wake of the report Friday, but not enough to offset losses in previous sessions. For the week, March wheat lost 9 cents, while the nearby corn contract moved 27 cents lower. Soybeans reacted bearishly to the supply and demand report as the March contract posted a weekly loss of 22 cents, while nearby meal prices declined about $6 per ton. In the softs, cotton couldn't escape the carnage this week as the March contract lost 30 cents per hundredweight. In the dairy market, March Class 3 milk gained 26 cents, while the deferred contract moved 18 cents higher. Over in livestock, April cattle lost $2, nearby feeders were off more than $4, and the April lean hog contract posted a weekly loss of $2.63. In the financials, the euro lost 300 basis points against the dollar, crude oil declined by $2 per barrel, COMEX gold fell by $3 per ounce, and the Goldman Sachs Commodity Index fell more than 2 points to settle at 677.20. Here now to lend us his insight on these and other trends is one of our regular market analysts, Jamey Kohake. Jamey, welcome back.
Thanks, Mike.
It's good to have you here. It's been an interesting couple of weeks in the broader market. We saw the Dow touch 14,000 last week. This week there was some news. The dollar. We saw the value climbing in the dollar. What's going on there? What's driving that?
Right. We saw the dollar get back above 80 late this week. It came from Draghi out of Europe, saying that he wants to kind of rebalance the risk with the euro. And that was kind of a quasi verbiage for we're going to weaken the euro up, which should be bullish to the U.S. dollar index. So that was why we got above 80. The key will be to stay above 80 next week and use that as support now. I do like selling the euro, 135.90 area. I know that's sharply higher than where we are now, but if we can get a day or two of rally next week, I would get short the euro. So
as of right now, we've got the EU and Japan both actively trying to weaken their currencies as compared to the dollar.
Yeah, I wouldn't say Europe is as active as Japan is yet of printing money like we have been, but it could be longer term down the road.
They're throwing the idea out.
But Draghi's got the rumors out.
As we look for export news as it relates to the grains, is this move going to have a significant impact on future exports?
It could longer term. It won't much right now. Low 80s isn't that big of a factor. You get 83, 84, yeah, you could slow wheat down or corn down, but here right now it shouldn't be that big of a factor yet.
Okay, so something to keep an eye on as we go forward.
Yeah, especially too specking with gold or silver, with crude as well, to keep that eye on as well.
Okay, well, let's look at wheat. Let's talk about how the wheat market's been moving. What did we see in this supply and demand report today, and how is it going to impact the market?
It was supportive, what we saw today, and wheat actually, I thought, held together halfway well considering what we saw in the soy complex. But what's going on in wheat, though, is exports are pathetic. There's not much wheat moving at all. Egypt's been a big buyer historically of wheat. They're financially in a turmoil right now, so they're just buying pretty much hand to mouth. Argentina and Russia are rumored to be looking for wheat. There's no confirmation of it, so we're kind of just sitting back, grinding lower. The easiest path has been lower, and that's what we've seen. I would look to start to build a long position about 15 cents below the market is now. We got the 200 today, technically below the market, and I think you could use that as support to buy into. We just need some fresh exports, and I think you'd see a nice correction.
So if we see this market continue to slide, then we get the news out of Argentina or Russia. You think there's some bullish sentiment there if the market
Right, we
conditions
need a
change
catalyst.
little
We
bit.
need the catalyst to exports or some more dryness. We have some scattered rains across the plains on the major, but yeah, some type of new catalyst that would bring some new money, and I think pop at 30 cents.
All right, and now looking at production here in the U.S. on the plains, there's been all sorts of talk about how poor the crop is looking out there with this ongoing drought. What are you hearing? How is that having an impact on the market yet, or are we still just waiting
It
to see?
has. I think it's in the market right now. It could get worse than seeing rally, where we were, but it's factored in right now. It's bad. South Dakota, worse in a generation. Southern Plains very, very, very dry, especially down on the Panhandle as well. But that's in the market right now. We need exports. Weather is kind of in the market.
Well, and as long as we're talking exports, let's look at corn. There's another story there. We haven't had any exports all winter, and that's continued. Where do you see corn going from here?
I see corn as a range-bound trade. I see 708, good support in March, up to about 740, 745. Get through the 750 market resistance. We need, like you're saying, exports, and they're not much out there right now besides routine business. Next week, China is on their lunar holiday break, so it could be another depressing week volume-wise, again, for the ag, so I don't see much happening next week. But for an end user, a spec trader, 708 March is where I buy at, pit stop close below 7, look for a bounce back to 730.
Now, as we talk about the supply and demand report for corn, we did see a little bounce today. Was that just spillover buying? What was happening in the corn
A little
market?
bit of spread liquidation, long beans, short corn being liquidated. Corn number, a little bit bearish, but nothing major. Actually held in pretty well. We have seen a beating come into the new crop contract. So got it slammed midweek. I think it is range bound as well, 550, 580. That number seems kind of depressing, but that is about where we were last year at this time as well, so not a big surprise there. But I think if producers wait till we get to March, get this crop insurance month over with, I think we'll have higher prices then based off of weather, the dryness here as well.
So hold off on marketing any of your 13 crop? And
I would hold off for the new crop stuff. I think we can get 6 plus 6 yet, but I think it's going to be probably early to mid-March once we get through February with the crop insurance numbers being figured.
And it's probably going to be weather driving corn market in this early part
weather
of spring.
and how big or small South America's crop would end to shift demand to us if they do have a short crop.
All right. Well, let's talk soybeans. It's been a huge market swing these past couple days in soybeans, and we saw it today, a 22 cent drop today. What's going on in soybeans? How did this report affect that market?
Everybody has been long wheat. It's kind of been the bull market of the ags here the last few weeks, that and the meal market. And we've been trying to get through 15 bucks all week long and haven't been able to do it. Surprisingly, the report this morning domestically was bullish, but Brazil came in a little bit larger on the estimates there, flushed everybody out, broke stops, broke the moving averages, and just ran everybody out of the market. The sentiment right now by the trade is that Brazil's larger crop estimates can make up for the smaller crop in Argentina, and that's where the bearishness came from.
How much of the selling today and the past couple days was emotional? I mean, is this some gains we're going to take back as we have time to really soak in this report, or are we going to be now trading down in that low to mid 14 range, or even lower?
I think the old crop is fine. I think it'll be bought into. I think 1344 is a good spot, and down to even in the teens is even better support. If we could get down there next week, I would be long again. Exports have been still very, very stout for the beans, and I look for that to remain that way until we get further along into the harvest in South America. They're about 15% as of last week, but everybody was long. Funds sold about 11,000 contracts on Friday, and once we started breaking support, moving averages got broke. It was just a sell-a-thon.
Snowball selling as the market descended. Now, looking at what's coming out of South America, what's their delay in terms of from harvest to getting exports out the door of the country? Is there a significant time delay in Brazil?
There is a time delay. Barges are backed up right now. China has moved some of their barges down there already in anticipation they can get it cheaper than us. But yeah, there is delay. Transportation is still a major problem down there, getting it to the port and then getting it moved out. The next thing we're probably going to see on the horizon is strikes coming out of South America. It seems like every year at harvest there is a port strike somewhere, so I would start watching those rumors and see how that plays out. But I like the old crop, still buying it. New crop, just like the corn got slammed this week, we're down over 60 cents at one time on new crop beans. I'm holding off on it as well once we get through the February, March time period, see if we can get part of this sell-off back to sell into.
And again, weather's going to be the prime driver in new crop beans?
Weather, acres as well. Are we going to get our 99 million acres or not? Or are we going to see a little bit of shift yet?
All right. Now, as far as producers looking, we saw decent prices on new crop. Your advice is really just stay out of the market until
I don't like the
settled.
current level of prices. You get closer back to 6 in corn, I would take a short-term sell there. You retrace part of today's losses in beans halfway up. You could play a short-term sell there just to get through February. But I think once we get through February, I think we'll see a rally to be able to sell into. There's just not much in February historically. It's just kind of a dull month. Easiest path is lower right now.
Slow news,
right.
Markets just selling. Let's talk cotton just real quickly. We've seen a couple decent weeks of jumps in the cotton market, and today we had this week we had the 30-cent sell-off. What's going on in cotton?
Broad-based selling caught it. We went on a nice rally too and saw some tech selling. I think you still buy the breaks in the old crop. July down around 80.60. I like that. The stop close below 80, and I think we will remain supported down there as long as the dollar doesn't get too hog wild, up above 81 or 82. But it's the acreage game there, less acres, and look for it to remain supported.
So fairly bullish fundamentals in cotton, regardless of what China's got stocked away.
Right.
All right, things to keep an eye on there. Now, as we look to livestock, similar story there. Huge sell-off across the board on livestock this week. Walk us through what's going on with live cattle.
Technically, just seeing the market melt down. Same as the grains, all the moving averages being broke, a lot of tech selling off of that, supports levels being broke. Cash market this week, $1.25. That's going to be, I think, disappointing for next week. I think you still buy the breaks based off the supply side of the market, especially in live cattle. I like April at 130.40 area and looking for a bounce back to 134. 134 is 200-day moving average. I think you can see a bounce back up into there. But we're going to have to see the selling slow down in the feeder cattle market as well, and the hogs, and just build a base here and then see some new money come back in. And
new money coming in, we're looking at outside fund traders basically to get excited.
Money gets a spillover from the equities at times, but we need the cash market stabilize, hold in here, get some new demand to pick up and see a rally off of that.
Now, as we look through the summer and into the fall, what are your thoughts on live cattle there with this tight supply situation?
I'm still bullish there, especially if demand, keeps up or better than where it is currently right now. I think you still see, $4 to $6 rally to sell into for the fall. But right now, technically, the market is very, very weak, and we just like the grains, we need a catalyst. Some new demand, cash market to perk up, and I think you would see some new money come in.
And we talk about needing a catalyst in not this week, but the week before. We had both the cattle on feed report being traded and the news out of Japan. They're accepting older beef.
Yeah.
And that didn't seem to really be able to pull us forward. Is the Japan news longer term going to have...
Longer term will be supportive on that, but I think those reports, the two cattle reports plus Japan, just show how tired and weak the market is technically. We only got 1 day of spillover off of each report, and if we're as bullish as those reports were, that's very, very disappointing. And I think that's what scared some money. I was like, we get 1 day, get me out, we'll correct, and I'll buy into it again later.
So hopefully the market will digest it. We'll get some other catalysts going forward, and we'll begin to see trading higher.
I think so for sure. That's why I like the April, a little more of a setback at 130.40.
All right, well, let's talk feeder cattle. We had another sell-off in feeder cattle this week, as we've seen corn prices trade a little bit lower. What's going on in feeder cattle? Just spillover from...
Spillover, broader-based markets, tech selling. Charts there are weaker than the live cattle charts are. But we've seen the deferred contracts really get beat up this week as well with the lower corn trade. I still think there's another dollar and a half down in the feeders. Just technicals, I think, going to go down and retest the recent lows. We're so close to it now, why not? And then start back up again. Longer term, I think we're fine. We're just flushing everybody out right now and then starting pretty much back over again.
So as far as touching those lows time frame wise, next couple of weeks?
Yeah, I think next week, I think so. I think demand or volume will be light again next week. News will be light again, and the easiest path will be lower starting off next week.
Folks will be looking for reasons to get out and taking the prices. All right. Well, let's look at hogs. Same story in hogs. Walk us through the hog market.
Seasonally, this is a bearish time period for hogs. Bellies fell out of bed this week, down over 20 cents at times, and packer margins are weak right now, and that spurred some long liquidation and some tech selling as well. I like being long hogs on this break myself. I like April at 85.40 and look for a run up back to around 87. 200-day moving average is up there. I think you just run up there, stall out, and just see what happens with the other ags as well. But I think we're getting close to bottom in here, and I would look to sell some puts or buy that April 85.40.
And that's where we're probably going to bump into that resistance, is up around that 87
87 area, 200 days up in there.
And you think we've probably got, again, you'll be waiting probably through early summer to begin to see us testing those levels, or is that
no,
more
I think
of a
you
near
did
term?
the next 2 weeks or so. That area, I think we'll have a lot of this bearishness factored in with the better weather, with the packer margins being weak, and I think that should be a factor in. I think bellies should stabilize as well next week and just see a little bit of bottom picking come in. I don't think we're back putting new highs in. Just start the week off lower, buy into it, and see maybe retrace to 87 within 2 weeks. Recognize
that this is a good time
to
enter that market. Real quick, Jamey, what are your thoughts on crude oil as we roll into the spring?
I think the risk is to the downside. The only reason we've been supportive for the last 2 weeks roughly is because of RBOB being let of gas. We've had about 4 refineries shut down on the East Coast, a shortage of fuel on the West Coast, and it shot the Atlanta gas prices the highest ever for early February. I think crude goes back to 95.
All right. Thank you so much, Jamey. Appreciate you being here with us today. That wraps up this edition of Market to Market. But if you'd like more information from Jamey on where these markets just may be headed, visit the Market Plus page at our website. You'll find expanded market analysis, audio podcasts, and streaming video of our program, as well as links to our Twitter feed and Facebook account, all free at the Market to Market website. Be sure to join us next week when we'll explain why America's first major high-speed railroad could be the end of the line for some California farmers. Until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success.